Hello, I'm James Yardley, and today I'm joined by James Harries, the elite rated manager of the Trojan Global Income Fund. James,
Hello.
thank you very much for joining us.
Hi, thanks very much.
James, maybe we could start if you just want to give a little bit of an introduction to the fund. What's its objective, and what sort of companies do you invest in?
Certainly. So it's a global equity income fund. We're trying to produce a balance between capital growth and income growth. We think that both of those things matter for investors, particularly if we're moving into a more difficult period. We're trying to produce above average returns relative to our peers, but with below average volatility. And we think both of those things matter. For this fund particularly, and often for Troy more broadly, we think that our key investors are those who have irreplaceable capital, if you like, and are in need of income. And those two things often coincide in retirement, and we're very cognizant of that. Now, of course, when you're young, volatility is your friend. You've got plenty of time to make up losses if you suffer a steep drawdown or a steep loss. But when you're not so young, that isn't the case, and actually volatility is your enemy. And we at Troy very much try to limit significant losses in order to consistently compound capital. And we think that makes for a better long-term return stream, particularly for the type of investors that I mentioned. So that's what we're trying to do. Now, the companies we try and invest in are those that we think are high quality, that are resilient, that are adaptable, but that have sustainably high returns on capital employed. And they tend to reside in particular sectors. So the majority of the fund is invested in areas like consumer staples, in healthcare, in particularly enterprise as opposed to consumer technology companies. And these are businesses that we can have something that we can say something sensible about what they might do on a 5, 7, 10-year view. We have very low turnover in our portfolios, and our holding periods are 10 plus years. So we want to be pretty certain about the types of businesses in which we invest and the resiliency of the cash flows which they produce. So that's where we concentrate our investments.
And I think you said recently you expect global equity returns to be lower going forward. So why is this? And also maybe connected with that, I mean, do you think we're going to now see a period where investors kind of look more favorably on dividend investing again, whereas, of course, the past few years until recently, it was all about the high-flying tech companies?
Well, absolutely. I mean, we've been investing on this basis for a long time. And we know that income investing tends to come into and go out of favor, depending on what recent returns have been. Of course, when the market's delivering you very strong returns, the riches that you're benefiting from completely outweigh the incremental but relatively dependable return you get from an income stream. Now, my contention is that we have a slightly unfortunate, you might say, or a slightly different backdrop today to that which we've been in for the last 10, 12, 14 years. Of course, for all that period, money has been essentially free. We've had very, very low interest rates, and we've had incredibly supportive policy, both monetarily, but also more recently fiscally, because there was no inflation problem. And so the authorities could be very, very supportive and really quite aggressive in the way they supported equity markets, with the intention to push up asset prices, to stimulate consumption, to help the economy. Now, of course, that was all fine until inflation appeared, and it has. So that means two things. Number one, valuations were driven up to a level which is actually pretty elevated relative to history. And number two, that policy is likely to be less supportive in the future than it has been in the last 12, 14 years. After all, interest rates have gone up really quite substantially over the last few months. Now, the reason we think, therefore, that returns are likely to be relatively low is because returns are a function of initial valuation. If you buy an asset relatively inexpensively, then you can expect reasonable expected returns in the future. But the opposite is also true. If you have elevated valuations, that implies low returns. Now, if we are in a period where returns are likely to be lower, assuming that markets don't fall substantially or therefore are repriced substantially, and therefore the expected return improves. But if that isn't the case, then the returns are likely to continue to be relatively low. Now, in that case, as I mentioned, the dependability of an income stream and the incremental return that is generated by that income stream in the context of a relatively low overall return, total return, can be very powerful and can be very useful, particularly, as I mentioned, for the type of investors that we target, which who have irreplaceable capital and in need of income. So put all that together, we think that, yes, income investing is likely to be a little more favorably looked upon by investors in the next few years than it has been potentially in the last few years.
And you mentioned that dividend policies tell you a lot about a company. What do you mean by this?
Well, a dividend policy is, I mean, obviously a dividend is a reward in a sense for being a shareholder, but it also is a number of other things. A dividend is, in a sense, a management team's, or more specifically, or more properly perhaps, a board's best guess at what a sustainable mid-cycle, through the cycle earnings number is for a company. You shouldn't be distributing more than a proportion of that you think is bearable by the company. But it also tells you what the capital intensity of that business is. If you're able to pay out a reasonable level of income paid out of so-called free cash flow, or cash flow that's generated by the business after all the other capital needs of the business have been met, then it tells you something about the type of businesses you've got. And really high quality businesses that have low capital intensity tend to be able to pay high and sustainable dividends over time. It is also a constraining influence on management teams. So if you pay a dividend, if you pay too much of a dividend, it can mean that you underinvest in your business. But if you don't pay any dividend at all, you can end up squandering capital. So the level of dividend also is a constraining influence on management teams and tells you something about how they think about allocating capital in the portfolio, both with regard to shareholders, but also the business itself. And then the final point is that what a management team does with the dividend, sustainably grows it through time, or a step change in both the growth or not, tells you something about the success or otherwise, or the confidence or otherwise, of the management team and the board of the business. And a very good example of we've had of this recently is Reckitt Benckiser, which is a business that will be familiar to many people. It makes health and hygiene products effectively. Some of the portfolio makes you feel better if you've got a cold or flu. Some of it helps you clean your house. They have an infant nutrition business as well. But more recently, the management team have put the dividend up by 5% after a long period when that hasn't been the case. Now, our contention is, our view is that Reckitt Benckiser, after a long period of having a number of one-off problems that they've had to deal with, is now moving into a phase where that business is really finding its feet. And we're expecting that business will now be able to continue to compound consistently over the next few years in the way that it did before it had this period of some difficulty. And we think by putting up the dividend by 5%, the management team are indicating greater confidence in that business. So a dividend has lots of information within it, at the level of it, its growth over a number of years, how it relates to the capital intensity of the business, but also how the management team and the board are thinking about the business over the next few years and the confidence they have in that business.
Very interesting. Yes, I think we've all used Reckitt Benckiser's products, I'm sure.
Absolutely.
And yeah, maybe if you want to tell us about a few other stocks in the portfolio, what else is exciting you at the moment?
Well, a couple I might highlight, I suppose. One would be a company like Pepsi. I mean, Pepsi is an absolutely classic, global, high-quality consumer franchise, which we think will be able to pay and grow dividends long into the future. Now, Pepsi is an interesting business because it's called Pepsi, but actually it's really a snacking business. Although Pepsi is obviously a brand that's very familiar to people, the really key, the jewel in the crown of this business, if you like, is the US snacking business. By that I mean effectively salty snacks, crisps, and so on. And effectively it has some really dominant brands in this sector. It is 10 times the size of its nearest competitors. It has enormous power and force with retailers and enormous familiarity with consumers. And of course, and it has an international business which has a very long runway for growth. Now, what's interesting about the snacking business, of course, is it's one of these areas where when you want to buy a packet of crisps, you feel like a little treat, and you tend to do that periodically, and you don't care too much about what the cost of that little treat is. And that enables Pepsi both to have attractive margins, but also to be able to increase price should there be a more inflationary backdrop, which they have very ably demonstrated recently. So it's a wonderful franchise. It's a wonderful business. It's the sort of business we can hold forever and will deliver us a return pretty consistently balanced between income and growth. The second one I would mention is a slightly different business. It's Nintendo. Again, it's a business that will be familiar to many of us, but particularly our children. My son is a very keen Nintendo gamer, as I I have to say I was when I was a child. And actually that's quite interesting in itself.
Definitely familiar to my son, that's for sure.
Right, there you are. But that's quite interesting in itself because it's a family-friendly gaming company. It has basically timeless IP. I mean, I was playing Donkey Kong in the same way that my son plays Donkey Kong all these years later. And that shows you the sort of strength of the intellectual property which Nintendo has and which we view as being under monetized, if you like, relative to other globally recognized, incredibly powerful intellectual property. Now, the reason we're particularly excited about Nintendo's prospects today is, first of all, it's relatively inexpensive. It's completely ungeared, has net cash on the balance sheet. But others may have known that they've recently launched a film, Super Mario Brothers, which I have to say I went to see at the weekend and I thought was very, very good, as did my son. And to be more serious for a second, and also absolutely smashed all box office records. It's the most successful opening weekend for any animated film. Beating Frozen 2. I mean, it's absolutely incredible. Funnily enough, the critics didn't particularly like it, but all the consumers love it, which probably tells you something about the critics. Anyway, what's interesting about this, to be serious for a second, is not simply because it's a great success, the film, but it demonstrates that Nintendo is serious about monetizing in a greater way this incredible, timeless portfolio of IP that it has. The second point to make is that it's currently got a console called the Switch, which is one of the most successful consoles of all time. But in the past, when Nintendo has launched a new console, and the Switch is relatively long in the tooth, some of them haven't been a great success. Now, our view is because you now have an individual account with Nintendo through which you download software and upgrade the operating system, the persistency of the client base from the Switch to the new console, which is going to be called the Switch Pro, and is likely to be launched this year or next year, is going to be far more predictable than in the past. And if that is the case, then we think the share price will react very positively to that. So it's a well-known global, again, franchise gaming company, which not only do we think is a wonderful business, but we think is particularly well positioned today.
Well, that's absolutely fascinating. Thank you very much, James. Those were some really good examples.
Thanks very much indeed.
And if you'd like to learn more about the Trojan Global Income Fund, please visit fundcaliber.com.